Hey everyone, welcome back to Satoshi Finance. Today, we're diving into a topic that's crucial for anyone interested in building wealth and securing their financial future: stock market basics. Whether you're a seasoned investor or a complete beginner, this video is packed with essential information to help you navigate the world of stocks, bonds, and ETFs. So let's get started. In the vast landscape of financial markets, the stock market stands as a bustling marketplace, akin to a dynamic city center, where investors engage in the buying and selling of ownership stakes in companies. At its core, the stock market serves as a vital mechanism for companies to raise capital by issuing shares to the public. This act of going public not only allows businesses to access funds for expansion, innovation, and other strategic endeavors, but also provides investors with an opportunity to participate in a company's growth and success. The stock market's significance extends beyond the individual transactions occurring daily. It plays a pivotal role in the broader economy by facilitating the flow of capital. As investors trade shares, capital circulates between buyers and sellers, fostering liquidity and contributing to the efficient allocation of resources. This circulation of funds allows businesses to pursue new projects, create jobs, and stimulate economic growth. In essence, the stock market operates as a dynamic ecosystem, connecting businesses in need of capital with investors seeking opportunities for financial growth. Understanding this fundamental role is key to navigating the complexities of the stock market and appreciating its profound impact on the economic landscape. Now, let's delve into the fascinating world of stocks. At its essence, owning a stock means acquiring a tangible piece of a company, and this ownership is analogous to holding a slice of the corporate pie. Stocks come in various forms, with common stocks and preferred stocks being the primary categories. Common stocks represent the most prevalent type of equity, granting shareholders voting rights in company decisions and a share in its profits through dividends. On the other hand, preferred stocks often offer a fixed dividend but may not carry voting rights. The question naturally arises, why would you want to own stocks in the first place? Well, stay tuned, because the answer lies in the potential for both financial growth and involvement in a company's success. As a shareholder, you become a part owner of the business, and your fortunes are intertwined with its performance. When the company does well, the value of your shares may increase, and you may also receive a portion of the profits in the form of dividends. Understanding the distinctions between common and preferred stocks, as well as the inherent benefits of stock ownership, is fundamental to making informed investment decisions and harnessing the wealth-building potential of the stock market. Let's shift our focus to the world of bonds. Unlike stocks, which signify ownership in a company, bonds represent a form of debt. When you purchase a bond, you're essentially acting as a lender, providing capital to a company or government entity. This financial instrument serves as a formal agreement between the issuer and the bondholder, outlining the terms of the loan, including the principal amount, interest rate, and maturity date. The concept of fixed income is a key element in understanding bonds. Unlike stocks, where returns are tied to the company's performance and dividends are variable, bonds offer a more predictable income stream. The interest rate specified in the bond agreement remains fixed throughout its tenure, providing investors with a steady and predetermined flow of income. This stability is particularly appealing to investors seeking a reliable source of returns, and is one reason why bonds are often considered a more conservative investment compared to stocks. In addition to fixed income, bonds typically involve regular interest payments known as coupon payments. These payments are scheduled at specific intervals and they represent the interest earned on the principal amount lent. Exploring the dynamics of bond investments, including the factors influencing bond prices and yields, is essential for investors aiming to diversify their portfolios and manage risk effectively in the financial markets. Now, let's explore the world of exchange-traded funds, ETFs. Have you ever heard of them? If not, you're in for a treat. ETFs are financial instruments that offer investors a fantastic way to diversify their investment portfolios. Unlike individual stocks or bonds, ETFs pull together a collection of assets, such as stocks, bonds, or commodities, and then divide the ownership of that pool into shares that are traded on an exchange. The beauty of ETFs lies in their ability to provide investors with instant diversification. By holding a basket of different assets, ETFs spread risk and offer exposure to a broader market segment. This diversification can be particularly appealing for investors looking to minimize risk while still participating in the potential returns of different asset classes. Moreover, ETFs trade on stock exchanges just like individual stocks, providing investors with the flexibility to buy and sell throughout the trading day at market prices. In this section, we'll delve into the mechanics of ETFs, exploring how they are created, the role of authorized participants, and why they have become an increasingly popular choice for both novice and experienced investors. Understanding the ins and outs of ETFs will empower you to make informed decisions about how to integrate these versatile instruments into your investment strategy. Now, let's delve into the diverse cast of characters that make up the stock market. It's a bustling arena where a variety of participants, ranging from individual investors like you and me to large institutional players, actively engage. Each participant contributes to the market's dynamism, bringing their unique goals, strategies, and perspectives into play. Individual investors, often referred to as retail investors, make up a significant portion of the market. They are the everyday people buying and selling stocks to achieve personal financial goals, such as saving for retirement or funding education. On the other side of the spectrum, institutional investors, including mutual funds, hedge funds, and pension funds, wield substantial influence. These large entities manage sizable pools of capital, making strategic investment decisions on behalf of their clients or beneficiaries. Understanding the strategies and motivations of these institutional players is crucial for comprehending market trends and potential shifts. To facilitate the interactions between buyers and sellers, we have key intermediaries: brokers and market makers. Brokers act as intermediaries between investors, executing trades on their behalf. Market makers, on the other hand, play a crucial role in maintaining liquidity by quoting both buy and sell prices for certain securities. In this section, we'll unravel the roles of these market participants, shedding light on how their collective actions shape the fluid dynamics of the stock market. Understanding the roles of each participant will equip you with valuable insights into the intricate workings of this financial ecosystem. Enter the beating heart of the financial world: stock exchanges. These institutions serve as the epicenters of market activity, providing a structured platform for the buying and selling of securities. Some of the major stock exchanges include the New York Stock Exchange, NYSE, the Nasdaq stock market, and the London Stock Exchange, each with its unique characteristics and listing requirements. In this section, we'll take a guided tour through these financial hubs, offering insights into their histories, structures, and the types of securities traded on each. Understanding how trading occurs on these platforms is paramount for any investor. The stock market operates on a continuous auction system where buyers and sellers submit orders to the exchange. We'll explore the order book, which displays these buy and sell orders, and the role of market orders, limit orders, and stop orders in executing trades. This insight into the mechanics of trading empowers investors to navigate the market with confidence, knowing how their transactions interact with the broader exchange infrastructure. Furthermore, markets have their own rhythm, and knowing when the market is open for business is crucial. Different exchanges around the world operate on distinct schedules, with specific trading hours and sessions. Whether it's the opening bell on Wall Street or the close of trading in Tokyo, we'll cover the global timeline of stock market activity. This knowledge not only aids in planning trades, but also contributes to a deeper understanding of the interconnected nature of global financial markets. So, buckle up as we journey into the pulsating core of stock market exchanges. Now, let's turn our attention to the barometers of market health: market indices. These indices, such as the S&P 500 and the Dow Jones Industrial Average, play a crucial role in providing investors with a snapshot of how the overall market is performing. Think of them as benchmarks that reflect the collective movement of a specific group of stocks, giving us valuable insights into market trends and sentiment. Understanding what these indices mean is fundamental for any investor. The S&P 500, for instance, represents a diverse range of 500 large-cap US companies, while the Dow Jones Industrial Average focuses on 30 blue-chip stocks. We'll explore the methodology behind these indices, including how they are calculated and weighted, shedding light on why certain stocks have more influence than others. These indices act as a compass for investors, helping them gauge the general direction of the market. Whether it's tracking the performance of specific sectors, industries, or the market as a whole, Market indices are essential tools for assessing risk and making informed investment decisions. So, in this section, we'll unravel the significance of these indices, exploring how they serve as invaluable resources for investors navigating the vast landscape of the stock market. Now let's dive into the nuts and bolts of executing trades in the stock market. If you're gearing up to make your first trade, understanding the various types of orders is paramount. First up, we have market orders, which are the simplest and most straightforward. When you place a market order, you're instructing your broker to buy or sell a security immediately at the prevailing market price. It's a quick and efficient way to get in or out of a position, especially when the need for speed outweighs the need for a specific price. On the other hand, limit orders provide more control over the execution price. With a limit order, you specify the maximum price you're willing to pay for a buy order, or the minimum price you're willing to accept for a sell order. This order type allows you to set your price and patiently wait for the market to come to you. Additionally, we'll delve into stop orders, which can be used to limit losses or lock in profits. These orders are triggered when the stock reaches a certain price, helping you automate your trading strategy. Now let's spice things up a bit with the concepts of going long and short in the market. Going long is the traditional approach, where you buy a security with the expectation that its price will rise over time. On the flip side, going short involves selling a security you don't own with the anticipation that its price will decline. These strategies open up a world of possibilities for investors, allowing them to profit from both upward and downward market movements. So, buckle up as we navigate the intricacies of market orders and the exciting concepts of going long and short in the stock market. Let's face it, investing is a journey filled with both excitement and challenges, and understanding the risks and rewards is fundamental to navigating this dynamic landscape. First and foremost, we'll delve into the potential upsides. Investing in the stock market offers the opportunity for substantial financial growth over the long term. Historically, the market has shown an upward trajectory, providing investors with the chance to see their wealth grow through capital appreciation and dividend payments. However, with great potential for reward comes inherent risk. Market volatility is a reality, and the value of investments can fluctuate. Understanding the downsides, including the risk of losing principal, is crucial for any investor. That's where the concept of diversification comes into play. Diversifying your investment portfolio by spreading your funds across different asset classes can help mitigate risk. We'll explore the importance of having a well-balanced portfolio that includes a mix of stocks, bonds, and other assets to cushion against market fluctuations. Assessing your own risk tolerance is a critical step in developing a successful investment strategy. Each investor is unique, and factors such as age, financial goals, and risk appetite play a pivotal role in determining the most suitable investment approach. Whether you're a conservative investor aiming for stability or a more aggressive investor comfortable with higher risk, understanding your risk tolerance will guide your decision-making and help you weather the inevitable market ups and downs. So in this section, we'll unpack the delicate balance between risks and rewards in the world of investing, empowering you to make informed and prudent financial decisions. In the intricate world of investing, having a grasp of basic financial metrics is akin to having a compass to navigate the markets. Two fundamental metrics that investors often rely on are the price-to-earnings, PE ratio, and the dividend yield. The PE ratio provides insights into the valuation of a stock by comparing its current price to its earnings per share, EPS. A higher PE ratio may indicate that investors have high expectations for future earnings growth, while a lower ratio could suggest a potential undervaluation. We'll delve into the nuances of the PE ratio, helping you understand how to use it as a valuable tool in assessing a stock's attractiveness. Next up, the dividend yield is a crucial metric for income-oriented investors. This metric represents the annual dividend income as a percentage of the stock's current market price. Understanding the dividend yield is vital for investors seeking a steady income stream from their investments. We'll explore how to interpret the dividend yield in the context of a stock's overall performance and financial health, helping you make informed decisions about income-generating investments. Throughout this section, we'll not only break down these metrics, but also provide practical examples to illustrate how they function in real-world scenarios. By the end, you'll be equipped with the knowledge needed to evaluate stocks with a discerning eye, utilizing these financial metrics as your analytical tools in the pursuit of successful investment decisions. Welcome to the realm of investment strategies, where having a well-defined plan is the cornerstone of successful wealth building. In this section, we'll explore different investment strategies that cater to various financial goals and risk appetites. One prominent strategy is value investing, which involves identifying stocks that are undervalued relative to their intrinsic worth. Value investors seek opportunities where the market has underestimated a company's true value, aiming to capitalize on potential price corrections. We'll delve into the principles of value investing, examining how legendary investors like Warren Buffett have successfully employed this strategy. On the other end of the spectrum, we have growth investing, a strategy that focuses on companies with strong potential for rapid expansion and future growth. Growth investors are more willing to pay a premium for stocks with high earnings growth expectations, betting on the company's ability to outperform the market over time. We'll discuss the key characteristics of growth investing and highlight the types of companies that align with this approach. Regardless of the specific strategy, the essential takeaway is that having a plan tailored to your financial objectives is paramount. I'll emphasize the importance of aligning your investment strategy with your risk tolerance, time horizon, and overall financial goals. By the end of this section, you'll have a clearer understanding of various investment strategies, enabling you to craft a personalized plan that suits your unique circumstances and aspirations in the dynamic world of finance. In the fast-paced world of finance, staying informed is a fundamental aspect of making sound investment decisions. In this section, we'll explore the crucial role of financial news in providing real-time information about market trends, economic developments, and company-specific news. Keeping a finger on the pulse of the financial world through reputable news sources helps investors stay abreast of potential opportunities and risks that may impact their portfolios. We'll discuss how to filter through the noise and focus on relevant information, empowering you to make well-informed decisions based on current events. To delve deeper into market analysis, we'll cover the basics of both technical and fundamental analysis. Technical analysis involves studying past market data, such as price movements and trading volumes, to forecast future price trends. On the other hand, fundamental analysis centers around evaluating a company's financial health, examining factors like earnings reports, balance sheets, and economic indicators. By understanding the foundations of these analysis methods, you'll be equipped with valuable tools to assess investments comprehensively. We'll explore how investors can use a combination of technical and fundamental analysis to develop a holistic understanding of the market landscape and make informed decisions aligned with their investment goals. So get ready to navigate the world of market news and analysis to sharpen your investment acumen. Now, let's explore the critical distinction between long-term and short-term investing in the dynamic world of finance. In this section, we'll dissect the fundamental differences between these two investment approaches, understanding their respective pros and cons, and providing you with the insights needed to align your strategy with your financial goals. Long-term investing involves committing to an investment for an extended period, often measured in years or even decades. The primary goal is to harness the power of compounding, allowing investments to grow steadily over time. We'll delve into the advantages of this approach, such as the potential for higher returns and the ability to weather short-term market fluctuations. Additionally, we'll discuss the importance of a diversified and well-balanced portfolio in achieving long-term financial success. Conversely, short-term investing involves more frequent buying and selling of assets, with the aim of capitalizing on immediate market movements. While this approach may offer opportunities for quicker gains, it also comes with higher volatility and increased transaction costs. We'll explore the advantages and challenges of short-term investing, helping you weigh the potential benefits against the risks. Ultimately, the decision between long-term and short-term investing depends on your financial objectives, risk tolerance, and investment horizon. By the end of this section, you'll be equipped with the knowledge to make an informed choice that aligns seamlessly with your unique financial aspirations. So buckle up as we navigate the nuanced terrain of investment timelines. As we approach the conclusion of our exploration into the intricacies of the stock market, it's imperative to shed light on the regulatory landscape that governs financial markets. In this final section, we'll focus on key regulatory bodies, with a spotlight on the Securities and Exchange Commission, SEC, in the United States. The SEC plays a central role in maintaining the integrity of the securities industry by enforcing securities laws, regulating the stock and options exchanges, and overseeing key market participants. We'll delve into the functions of the SEC and its mission to protect investors, facilitate fair and efficient markets, and promote capital formation. Investor protection is a cornerstone of regulatory efforts, and we'll discuss the various measures in place to safeguard the interests of those participating in the stock market. From disclosure requirements to rules governing broker-dealers, these measures are designed to enhance transparency and ensure that investors have access to accurate and timely information. Understanding the regulatory framework provides investors with confidence in the fairness and reliability of the market, fostering trust in the financial system. In this concluding section, we'll underscore the importance of being aware of regulatory bodies and the protective measures they implement. This understanding empowers investors to navigate the markets with confidence, knowing that there are safeguards in place to uphold the integrity of the financial system and protect the interests of market participants. So, as we wrap up our journey through stock market basics, remember that knowledge about regulatory bodies is a crucial tool in your investment toolkit. That's a wrap for today's crash course on stock market basics. I hope you found this video informative and that it sparks your interest in the fascinating world of investing. Remember, this is just the beginning. Keep learning, stay curious, and always do your research before making any financial decisions. If you enjoyed this video, don't forget to like, subscribe, and hit that notification bell to stay updated on our future content. Thanks for tuning in, and I'll see you in the next one.